Welcome to the Explainer. Today we are diving deep into one of the biggest stories out there right now, something that's shaping both finance and tech. We're talking about the insane, absolutely massive build-out of AI data centers. We're going to peel back the curtain and look at how these multi-billion-dollar projects are actually getting funded and, what that all means for investors.
It all really boils down to this one simple, powerful fact. AI is hungry. It's hungry for power, for chips, and for a whole lot of cash. Let's be clear, the AI revolution is not cheap. The biggest cloud companies, you might hear them called hyperscalers, they are spending absolute fortunes to build out this infrastructure. And more, it's the debt markets that are footing the bill. And that creates this really fascinating, super complex web of risk and reward.
And look, when we say fortunes, we're not kidding. We're talking about $100 billion plus every single year. And that's just from the biggest players. A number that big, it just begs the question, right? How on earth is all of this getting paid for without completely wrecking their balance sheets?
Okay, so let's get into it. The answer lies in something that's often called the shadow financing stock. Sounds a little mysterious, right? But really, it's just a super sophisticated system they've designed to fund these enormous projects. And the key part is, it's often done by keeping all that debt off the tech giant's main corporate books. All right, but before we get into the nuts and bolts of that structure, we need to talk about a key tool that investors use to measure risk. It's called a credit default swap, or CDS for short. The easiest way to think about it is like an insurance policy on a company's debt. So you pay a fee, which is called the spread, to get protection. Now, if the market starts to think that company is getting riskier, what happens? That fee, that spread, goes up. It's often one of the first signs of smoke, an early warning that something might be up. So here's how the money actually flows. It's kind of like a three-step process. First, a big tech company will create a totally separate legal entity, a special purpose vehicle. We'll call it an SPV, just for one specific data center project. Okay, step two, huge asset managers and private credit funds, they come in and lend money directly to that SPV to get the construction going. Then, step three, once the whole thing is built and running, it can get refinanced by data center REITs, those are real estate investment trusts, and they issue their own bonds out to the wider market. Okay, so this is the absolute key takeaway here. Using that SPV basically ring fences the risk. It puts a financial wall around it. The debt is tied to the project itself, the land, the building, the money it's going to make in the future, and not the parent tech company. And this is just so vital when you're spending tens of billions of dollars, because it protects the parent company's super clean, pristine credit rating from all the risks that come with one single giant and kind of clunky construction project. Now, what's so interesting about all this is that the biggest risk, it's not just about all this clever financial engineering. Nope, it's actually about physics. It all comes down to getting enough electricity to these incredibly power-hungry buildings.
Yeah, seriously. Forget about the construction crews pouring concrete or even the teams installing the servers for a minute. The entire schedule for one of these multi-billion-dollar data center campuses often comes down to one single thing. Can the local power company actually deliver hundreds and hundreds of megawatts of power to that specific spot? You've got these long queues to connect to the grid. You have to build brand new substations. Honestly, that stuff can dictate the timeline way more than the guys in hard hats. And this really brings home the most important takeaway for investors. It's simple, right? A delay in power means a delay in flipping the switch on the servers. And that means a delay in making any money from all that super expensive AI hardware inside. You should honestly be tracking these power connection milestones just as closely as you're tracking GPU deliveries from NVIDIA. So all of this, it brings us to a really fascinating contrast in how the big tech players are handling the risk. Because believe me, not everyone is playing the game the same way. Just look at this. You've got two totally different philosophies at play here. On one side, you've got a company like Oracle. They tend to just borrow the money directly on their main corporate balance sheet. So what does that mean? It means their own credit rating is much more sensitive to whether all this AI spending pays off. But then on the other side, you have Meta. They're using those off-balance sheet SPVs we talked about, which acts as a cushion, insulating the parent company from the direct debt of any single project. And this scorecard, it really clears things up, doesn't it? You can see Oracle is the most sensitive to any kind of funding stress because, the debt is on their own books. Meta, they're a bit more sensitive to the risk of actually getting these projects built and running inside their SPVs. And then you have the giants, Amazon, Google, Microsoft. They're just swimming in cash. So for them, the primary risk isn't about getting the money. It's about whether they can actually turn all this massive, massive spending into real profitable AI revenue. It's a totally different kind of pressure.
All right, so what does all this mean for an investor, for you? Let's try to map out what a worst-case scenario looks like, and probably more importantly, what are the early warning signs you should be watching for?
So let's play this out a little. What's the worst-case scenario here? How could this whole super optimistic AI build-out thesis actually fall apart?
Well, it's almost never just one single thing, right? The real danger is when you get a perfect storm, when all these different pressures start stacking up on top of each other. Just imagine it. The spending stays ridiculously high, but that AI revenue everyone's counting on, it just doesn't show up as fast as expected. Then, a price war kicks off, squeezing profits right when those power delays start adding unexpected costs. It's like a cascade of bad news. And in a severe downturn like that, the impact, it could be really significant. You'd likely see what's called a double hit to the stocks. First, their earnings estimates would get slashed, and second, the market would suddenly be willing to pay a much, much lower price for those already lower earnings. For the companies that are most exposed, well, that could mean a very, very painful drop in their stock price. So what can you actually watch for? Here are the practical, real-world signals. Think of it as your early warning dashboard. First, CAPEX productivity. Is the AI revenue growing faster than the spending? That's number one. Then, power milestones. Are they hitting those crucial power connection approvals on time, or are there delays? Next, financing windows. Are these companies able to refinance their project debt easily, or is it getting harder? And of course, pricing behavior. Are you seeing any unexpected discounts on AI cloud services? All of these, they're the canaries in the coal mine.
At the end of the day, this whole thing really comes down to a simple truth. The AI build-out is absolutely real, and it is incredibly, mind-bogglingly expensive. But just throwing money at the problem isn't going to be enough. The real winners will be the ones who can match that massive capacity with flawless execution in real financial discipline. So the big question is all this historic spending truly building the future, or is it just building a monument to ambition? That right there is the billion-dollar question you should be watching.